Hello, I hope you're strapped in for this. This is part 2 of smart investing, choosing the right options for a wealthy life. I started this last week and I talked to you about some of the more simpler forms of investing, shares, bonds, commodities, and then I briefly spoke to you about mutual investments, which is sort of an American term, but it's about a fund where you put everything together. Now we're going to go on and we're going to talk about EFTs, which are exchange traded funds, and also look at cryptocurrency briefly, just so that you get a broad, narrow, shallow understanding of the different types of investment opportunities that are out there. And then when I talk to you about property, you're going to understand how, for me, it stands out, how I believe that it should be the foundation of your investing. And then you're going to be able to make a more informed decision moving forward. You're going to need to get financial advice, obviously. So the same caveat that I gave last week, it's important to keep in mind that all forms of investment involve risk. And before investing in any form of asset, you need to understand your overall financial goals. And as I said last week, your tolerance for risk, your risk appetite. So basically, how much could you afford to lose if things were to go wrong before you'd feel very, very stressed? And that will tell you your level of risk, your appetite of risk. It doesn't mean to say that you're going to invest in something with the intention of it losing money. Of course you're not. But you need to be aware that there is always a risk. And then once you've understood what you want to get out of this process of investment and what your attitude is, what your values are, then you can start to create an overall investment strategy. And when I work with my clients, before we even get to the investment strategy, we're looking at what is the life strategy? What is the strategy that's going to help you move from where you are now towards that wealthy life that you really want to be living? And for most people, that is a life that involves income that doesn't just come from working in a job or running a business, that there is some other form of regular, semi-protected type of income that you can rely on so that you can generate this income to pay your bills, for example, and then know that you don't have to go to work, but you're now going to work because you choose to. Or you don't have to work until you're 65, 67, 70, whatever number it turns out to be, because you have this alternative form of income. You're in a position where you can take back control of your time. For some of the clients I work with, that's all they need. For other clients, once they've achieved that and they see that it is possible for them to take back control of their futures, their time with their families, they then want to go on and co-create a property investment strategy. And sometimes we just create the strategy and they go off and they do it themselves, and maybe I act as their mentor. But more recently, people are using my skills and my contacts to tap into me, leveraging again, if you like, the knowledge and experience that I've got in the property investment market. So with all investing, you are going to need to understand the journey that you're embarking on, understand that it's for the long term, that it's going to include some form of risk. And what you're then going to need to understand is that for you, is the risk mitigation of this particular strategy better or worse than something else? And I feel, maybe because this is where my experience lies, that it is easier to mitigate the risks in property investment because you have more control over a physical building, particularly if it's a house rather than a flat, and you have more control over, to a degree within the law, putting tenants in and getting tenants out of your property. When you buy a share, you have no control over that company because you're never going to be able to buy enough shares that you can control the decisions the company makes. If you buy a bond, you're going to have no control over the country whose bond you've bought. And if you buy a commodity, how are you ever going to affect the, I don't know, environmental factors affecting corn, or the shipping factors affecting oil, or anything else. So when you get into these sort of bigger, more broader investment strategies, it feels harder, I think, to be more personally connected, where, not that you should ever interrupt the life of a tenant, you could do a subtle drive-by of a house. You could drive down the road and you could go, I own that house, you know, and see your actual investment. It's not the same with a share, and definitely not with crypto that doesn't really even exist in the first place. So let's look at some of these last couple of investment styles that I would talk to you about. So EFTs, an exchange traded fund. So an exchange traded fund. This is, if you like, a bit like a DIY or easier form of a mutual fund. So a mutual fund is something that is set up by one of these investment companies, and it is sort of bigger and set in stone. An EFT, again, will provide that instant diversification for you, but it's easier to trade these as if they were a stock. So if you just held stocks in a company, and the timing was right, you could give instruction, I want to sell that stock, and it could be sold and you could get the money that it's there. With a EFT, you can do the same, because an EFT is traded on the stock exchange. And because this is easier to do, you're also going to find that there are probably, lower management fees. So I think I mentioned last week that there was a company called BlackRock that do mutual funds. BlackRock, Vanguard, Invesco, they're also companies that do EFTs. And so what they do with these EFTs is they basically establish an overall objective and strategy for the EFT. They turn around and they say, this is high risk, or this is low risk, this is medium risk. This is all about, for example, just following the performance of the top 500 of the American stock exchange, or the FTSE 100 of the British stock exchange. So those types of companies, the top 500 in the States, publicly traded companies, or the top 100 in the UK, if you were going to buy their individual stocks, would need to look at either 100 or 500 company reports in order to go, this is the company I want to invest in. And you read the company reports and you decide how they're going to perform in the future and know whether you want to buy into them. There's a lot of work there. Whereas if you bought an EFT that was lodged in one of these two, so the S&P 500 or the FTSE 100, the company that creates the EFT for you has looked at the 100 or the 500 and gone, and I'm just going to say a number, these are the top 10 best performers. That doesn't mean to say they are numbers 1 to 10, but they are the 10 that are most likely to increase in value and pay out good dividends. And then they group them together in a basket and give them to you as an already diversified investment opportunity. But the other thing you can do is you can get into things, for example, like emerging markets. So Canada, Brazil, India, even South Africa now are emerging markets. Or you can combine it with the bonds that we spoke about last week. So there is a company called iBox, and they group together corporate bonds, so not government bonds, but company bonds that are based in UK pounds, and they put these government bonds together. And so they give you that opportunity to tap into the bond market without, again, you having to check the risk of who you're effectively lending the money to. So it gives you direct access, if you like, to a wider investment fund. It provides diversification. It still carries risk. So let's just look at the pros and cons here of an EFT. So you've got the diversification I just mentioned about. So you're going to get a spread of investments across a distinct collection of investment securities. And this could be appealing if you want a level of diversification, but you're not just prepared to do all of the work for yourself. You want more than just investing in one stock. And of course, by doing that, you are, I think, probably providing yourself with a greater opportunity for success. Because if there is diversification, then you are going to rule out that one of those individual companies might not do well, or one of those bonds might not do well. You've got a lot more convenience with an EFT in that you can get this bought and sold within a trading day, just as if it was an individual stock. So again, you can quickly liquefy or quickly jump into a specific market or an asset class if you want to. It's going to be more cost effective than going through some of the bigger funds because the fees will generally be lower. But again, you need to look at all of that. And there are potentially, although I'm not going to go into this, there are some tax options on this. So some types of funds can potentially attract lower capital gains. I don't know anything about that side of it. I'm not a tax advisor, I'm not a financial advisor, but there are those opportunities, and it's worth mentioning those. But you still have got, to some degree, some of the same risks with stocks, shares, bonds, and commodities, in that the EFT is subject to market risk. It is subject to the performance of the companies that are held within that basket for you. So if those companies do go down in value, so your overall EFT, your overall fund will decline in value. And you give up some control here because you are buying into a preordained basket of securities. You're not going to turn around and go, well, what I really want is out of the top 100, I'd like this company, this company, this company, and this company. You're either getting what the fund creator thinks is the right selection of the top 100 or top 500 countries, or you're getting the emerging market fund, and they think that maybe only Brazil and China are worth looking at, or maybe only South Africa and India are worth looking at, or South Africa and Brazil are worth looking at. You're not able to pick and choose this. And the other thing is, just while I'm saying that these EFTs trade on the stock market, sometimes they open or close. So they're not always at there that you can buy into them. So that's what you've got to look at. And of course, I suppose I've got another layer of complexity here, in that you need to not only be checking on the stock and the share and everything else that's involved, but also the company that's put these together. Because I think if we go back to the original global recession that we had back in 2007, 2008, a lot of the trouble there was caused by investment companies grouping together bad investments and calling them something different. So if you ever did any of the research into what brought about the downfall, if you like, of the banks back in 2007, 2008, it was because they were buying into white labeled, glossy branded funds and bonds and investments, where they didn't really understand that what they were buying into was a whole pile of properties, for example, where the mortgage owners couldn't pay back the mortgages. So basically they were buying a whole bunch of houses that were going to have to be repossessed. So you really need to understand what you're getting into here. And that means understanding the components of the EFT that you're going to buy into, but also the performance of the company that's going to look after it for you. Now, if you think that through your mind, wait till we get to cryptocurrencies, because cryptocurrency, I suppose a share is really an intangible, but you do sort of understand that a share is a small percentage of the company that you've bought a share in. A cryptocurrency is a completely invented made up currency. This didn't exist years ago. Okay. So some of the names that you'll be familiar with are Bitcoin and Ethereum. So some very clever people, I mean, how genius are these people, have decided that we're not happy with the current banking systems. And I don't think people generally are. We're not happy with the idea that there are people controlling the movement of money, the value of money, the price of money. That's odd to say, but the money has a price. That's the cost of buying it, the interest that you have to pay. And so they weren't happy with this. So they thought, right, okay, we're going to step outside of the traditional idea of banking and this idea that there, whether it's a physical bank or an online bank, but that we are trading in what we know commonly as money, currency. And we're going to invent a new form of currency that we are going to control, and it's going to provide higher return for those that invest in it. And it's going to be outside of the normal money market. So it's going to be secret as well. And I think if you were an early adopter here, you will have made a substantial amount of money. I think, as with all things that are new, when you get into something later on, you can be affected by the volatility of the trading of the market. You can be affected by all the changes that come with something being older. When I say older, what I mean is the longer something is around, the longer people will have opinions, the more data there is about something. And therefore, when there is more information, it's easier to be critical, to have news stories. And of course, news stories can affect values, and therefore your prices can go up and down. So the thing about investing in cryptocurrency is, first off, you've got the risk of you are investing in something that doesn't really exist. You've then got your access points. So it's not like you walk into the high street or phone up a bank who are fairly known and are probably out there in the market, and you can find information on them. You've actually got to sort of tap into the process of buying these. So you have to have something called a wallet, and that needs two-factor authentication, and these can be hacked into because the wallets themselves are digital. So the currency is digital, the wallet is digital, the mechanism of buying it through something called blockchain technology. I mean, from what I understand, blockchain technology is actually a computer, really, or a series of computers. And there are people that will buy into the technology of it, and there will people that will buy into the cryptoness of it. But then you're also going to get the scams. And I got caught by one, in that the idea was to invest in crypto, and that's absolutely fine, not a problem with that. That's an investment decision. As I said, all investments can go up and down. And so to mitigate some of the volatility of investing in crypto, I was offered this opportunity to transfer my Bitcoin into another company that then used the Bitcoin to trade. And I think, in a sense, if I like put them all together, I was buying the intangible of Bitcoin and then using Bitcoin to buy into shares. And they were going to, in maybe in a sense, a bond in a company, and they were going to use my Bitcoin to then trade, and then I would get the money back, so that I was getting this guaranteed return through this second organization that would take out some of the high and low prices that Bitcoin or Ethereum or any of these other digital currencies can attract. And I don't even need to do the story, but you can guess it. Transferred my Bitcoin, and then I've never seen it again. And the company then decided to do something different and somehow kept my money and never had to pay me back. And there is no ombudsman, there is no organization that you can go to and go, oi, there's been some fraud here, because there is no way to turn with this. So in terms of the risks, you've got the volatility of it. It's not regulated, and it's uncertain how, let's call them the big boys, the governments, the regulators, the existing banks, the original status quo will treat people with crypto. You can't just take your crypto wallet down to the local supermarket and buy things with it. So its practicality as a currency in the true sense is very limited. And of course, then the whole thing being digital, as I just mentioned, you've got this whole hacking thing going on. But on the upside, if you want, you've got the potential for high returns. Obviously, the sooner you got into it, the better. That doesn't mean to say if somebody launches a new form of cryptocurrency tomorrow, you need to just jump on it, because you've still got to know that it's going to perform. It's attractive to some people because of this decentralization, that it's out of the central authority and the central banking system. It's not aligned with any government or main banking system. And so some individuals, particularly those that like privacy, would be happy with this. But also, if you can imagine, anything that then allows privacy is also going to allow crime. So there may well be a lot of benefit for those on the darker side of the line to use cryptocurrency. And you'll watch Hollywood movies where the ransom has to be paid in crypto, and here's my crypto account and you have to pay it in there. So there'll be that sort of nonsense coming down the line. It can be bought and sold fairly quickly. I would say my experience of that was actually much harder, because the process of when I set out to buy my crypto, which would have been, I don't know, 5-10 years ago now, whenever it was, there was a sudden run on crypto at the time. And because it's all run through computers and probably there wasn't the processing power, it took a long time. And although you set off aiming to buy, it's only when the purchase is completed that you get the value. So you can be stuck in that sort of an environment. So that is a whirlwind tour of crypto and EFTs. And as I said right at the beginning, I'm not a financial advisor, I'm not a tax advisor, I'm not a trained investment advisor. So this is my understanding and my research on these topics. The key thing here is I'm generally right in the description, and I'm very definitely right that there are risks and rewards to everything, and you need to understand the characteristic of the investment that you are going to get into. If necessary, you need to speak to a financial advisor before you get into your stock, shares and bonds. But if you do that, then you need to understand the modus operandi of the financial investment. Who pays them? Are they whole of market? If you decide to go to some sort of fund operator, so some company that's involved in this, what are their objectives? What are the objectives of the funds that they've put together? So there are layers of complexity here that will probably put off the majority of people, which is why, this is not something that everybody in the general public does. It will be easier for them to go buy a lottery ticket than it is for them to buy a good performing share or bond and actually make a return on it, because it's about being smart about your investment. It's about understanding what you're going to get into. Now, next week, I'm going to talk to you about property, and I can guarantee you everything that I've said still applies. You will need to understand the sort of market that you're going to get into. There are different types of properties. Do you buy residential? Do you buy houses? Do you buy flats? What's an HMO? Do you look at commercial? Do you buy land? Do you invest for planning gain? Do you invest to actually develop? So there's many, many techniques within the word generally property investing that you need to understand. There are different moods in the market. Are the prices rising? Are the prices stable? Are the prices falling? What is the demand for rental? What is the cost of money? What are interest rates doing? And the big one, of course, what is government doing? How is government interfering? What is the mood? And all of this needs to be put together to create an investment strategy that works for you. I would say probably the one place that property differs dramatically for me to all of this is the time commitment. And by that, I don't mean how long it takes to buy a house or manage a house or any of that. But if you're going to invest in property, you've got to be looking at a good 5 to 10 years as your initial investment plan. Whereas you could trade. I mean, people trade in shares, don't they? So you could trade shares. You could buy a bond for a year. You could be in a mutual fund for a year. You would not buy a house unless it was trading or some other sub-strategy. You would be looking at buying and holding property for the long term. So if you're thinking of stocks and shares as a place to put your money instead of leaving it in the bank, you can think of a property as a brick bank account. And if that's the case, you need to invest in that brick bank account for the next 5 to 10 years in order to really make the gains back on your investment. Because with all of these investments, there are buying in costs, there are fees to be paid. And for some of these, there are fees to manage. Like with your commodities, you're going to have to store your commodities places. Do you pay to have your barrel of whiskey stored in a duty-free warehouse? Or do you get your own safe put in at home to look after your gold or your valuable painting? So there is the management of all of this. And then there are the players that are involved. So who is your letting agent, your financial advisor, your managing agent? So there's a lot of complexity still there. And that puts people off. But I hope that by talking about this, you're going to start to go, okay, so I understand this, I understand that. I'd like to look at that a bit more. I do like the idea of property. I don't like the idea of property. I prefer the idea of a share. I prefer the idea of the tangibility of a buy-to-let property that I can drive down the street and look at, but not disturb the tenant. So you're going to have your own unique reasons for wanting to change your life for the better down the line. You're going to have your own unique set of values and attitudes towards risk. You're going to have your own unique composition of resources that you can put to this. Some people have a lot of time and don't want me to help them invest in property. They want me to teach them how to do it because they want to do it for themselves. So if you have plenty of money and plenty of time, you may choose to do it yourself. But if you have the money to invest and you're looking at 50, 100 to 200,000 as starting pots, then you may want me to do that because you're going to be off busy earning your next 50,000, your next 100,000. And because you can do that, your time is best spent earning the money in the way that you know it churns, even if that means that you're still working your 5-day week, because it's quicker for you to do that and make me find the properties for you than it is for you to stop the flow of income into your investment pot, take the time to do the investment, which means you've lost your wages because you're now focused on property investment. And the whole process would be slower and clunkier. So here endeth the lesson on smart investing and hopefully choosing the right investment options for you so that you can create a wealthy life for yourself. You know the caveats, you know there are risks involved. And what we're going to do next week is we're going to start looking at property investment and why it's the smart investment for a wealthy life, why it's going to put you in a position where you have that foundation that you can move on from there. My name is Vicky Wushay. Thank you very much for listening to a wealthy life and choosing the right investment options for you. I hope that this and last week's episode has really given you a broad understanding and helped you gain a little bit more whoosh into your investment knowledge and understanding. Thank you as always for listening. I'll see you next week.